Imagine waking up in 1999, right in the thick of the historic internet frenzy. The world was going completely mad. New companies were popping up like mushrooms overnight out of absolute nowhere. And anyone who could simply add a .com to their corporate name became an instant billionaire on paper. Every investor you met felt like an absolute financial deity, throwing their entire life savings into a handful of these tech stocks just because they had catchy names, watching their money multiply day after day, week after week. For a couple of glorious years, the numbers only went up, and everyone thought they were an absolute genius, until the fateful year 2000 arrived. What followed was nothing short of breathtaking. That bubble didn't just burst. It detonated like an atomic bomb across the global financial markets, causing a points drop never before witnessed on Wall Street. The Nasdaq plummeted nearly 80%. Traders were left completely shell-shocked in despair. And more than half of those revolutionary .com companies vanished into thin air overnight. I watched close friends lose millions of dollars in the blink of an eye as their entire fortunes completely evaporated. But here is the most mind-bending, ironic part of the whole story. The internet actually was the next big thing. The hype wasn't wrong about the civilization-altering power of the technology. It was just profoundly wrong about the timing, the execution, and the realistic value of those initial companies. Today, when I step back and look at the state of the modern financial markets, I get that exact same chill running down my spine. The actors on the stage have changed, but the script remains identical. This time, the grand illusion driving the collective euphoria is artificial intelligence. People are calling it a once-in-a-lifetime opportunity, a golden ticket to generational wealth. And maybe they are right. Or maybe, just maybe, it is the exact same story playing out all over again. As the legendary investor John Templeton famously warned, the 4 most expensive words in the English language are, "This time is different." But is it really different this time? With over 7 million of you turning to my videos for honest, grounded financial guidance, I feel a deep personal responsibility to give you my unvarnished take on this situation. So before you give in to the FOMO or begin to panic, let's take a collective deep breath, step away from the media noise, and look at the 3 hidden, interlocking forces driving this potential bubble, why they matter to your bank account, and exactly how you can position yourself to benefit from the impending market mayhem. Right now, the first hidden force you need to understand is that the fate of the entire stock market, and by extension, your personal retirement portfolio, isn't being decided by a healthy, diversified free market. The strings are being pulled by a tiny oligarchy of tech titans collectively known as the Magnificent Seven: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. Together, this elite group now commands an unprecedented 36% of the entire S&P 500 index. Think about what that actually means, even if you have never bought a single individual tech stock in your life and only own a simple conservative index fund. Over a third of your money is automatically riding on these exact 7 horses. Whether you realize it or not, your future financial returns depend entirely on how this hyper-aggressive AI arms race plays out, because every single dollar these giants invest sends shockwaves through the whole global economy. From semiconductor, chip manufacturers to local energy grids to your everyday mutual funds. When you look at the sheer mind-boggling volume of cash these 7 companies are pouring into AI this year alone, you begin to realize why the stakes are so terrifyingly high. Tesla is deploying $5 billion into autonomous neural networks in Elon Musk's xAI startup. Apple is allocating $10.7 billion just to inject actual competitive intelligence into its ecosystem and make Siri smarter. Though, to be completely honest, it's probably going to take a lot more capital than that. Meta is dumping a jaw-dropping $60 billion into massive data centers and infrastructure. Google is directing $75 billion toward rebuilding the fundamental fabric of the internet with AI. Microsoft is burning through $80 billion to fund OpenAI and build massive water-cooled supercomputers. And finally, Amazon is deploying an absolute war chest of $100 billion into AWS to ensure they own the cloud infrastructure that everyone else relies on to function. That brings the total to an astonishing $330 billion in a single calendar year. To put that number into perspective, that is more than the entire annual gross domestic product of highly developed countries like Finland or Portugal. All of this capital is being thrown into building what many are calling the Fourth Industrial Revolution. While that sounds incredibly exciting on paper, the scary reality is that this paper spending is essentially acting as a macroeconomic life support system for the current economy. Without this massive influx of corporate cash, the US and European markets might already be sliding into a noticeable recession. Global AI spending is expected to skyrocket to $500 billion by the end of 2026, with the projected spending on power and resources to feed the immense electricity demand topping $3 trillion annually by 2030. That is how badly these companies want to win this race, and frankly, you can see why they are terrified of losing. The International Monetary Fund estimates that roughly 60% of jobs in the developed world are exposed to AI disruption, meaning they will either be fundamentally transformed or entirely replaced by automation in the coming years. Whoever manages to crack this technology first will be rewarded with a crazy, almost dystopian amount of global power. Mark Zuckerberg explicitly stated that even if Meta ends up misspending $200 billion on this, it is completely worth the risk because moving too slowly means being permanently eliminated from the competition. This race isn't just between rival corporations anymore. It is a geopolitical Cold War between global superpowers like the US and China, both burning through billions to ensure they are the ones holding the technological reins. For everyday investors, this leaves us at a massive crossroads. If AI completely delivers on its exponential promises, the next decade could usher in a historic investing boom. But if the actual commercial profits don't arrive fast enough to justify these expenditures, the very tech giants lifting your portfolio today will act as a heavy concrete anchor, dragging it down tomorrow. This brings us directly to the second, and perhaps most alarming, hidden force, the mechanics of the AI money machine. When you pull back the curtain on how this money is actually circulating, the red flags start jumping out at you immediately. On the surface, everything looks like a standard, healthy supply chain. You have companies like NVIDIA, AMD, and Intel designing the chips. You have platforms like OpenAI and xAI building the models. And you have middlemen like Oracle or CoreWeave building the data centers and leasing out the computing power. But if you track the actual flow of capital, you discover a spectacular multi-billion-dollar financial merry-go-round. Let's look at the circular logic that has been playing out. Major tech investors give billions of dollars in funding to an AI startup. That startup immediately turns around and hands that exact same cash back to those very tech investors to use their specific cloud data centers. The tech giants then take that fresh revenue and use it to buy a massive mountain of high-end chips from NVIDIA. Then, NVIDIA turns around and reinvests its massive profits back into the original AI startups to keep them afloat. Doing this allows every single entity in this closed loop to record these circular transactions as skyrocketing corporate revenue, which of course pushes their respective stock prices into the stratosphere. It is the corporate equivalent of walking into the woods with a friend, paying him $1,000 to dig a hole, and him paying you $1,000 to fill it back in. On paper, you have both generated $1,000 in revenue, and if you were valued like a modern AI startup trading at 40 or 50 times revenue, your artificial hole-digging business would suddenly be worth tens of thousands of dollars. Obviously, this is a simplified analogy, and these companies are doing highly complex work, but the underlying illusion remains exactly the same. We saw this turn even crazier recently with massive multi-billion-dollar multi-party deals, where companies agree to buy chips only if the chip maker invests back into them. NVIDIA is the ultimate winner of this game so far, with its share price surging over 1,600% since the launch of ChatGPT, because they are effectively selling the shovels to every single miner on the battlefield. But by paying your own customers to buy your product via venture investments, you risk artificially inflating the true organic demand for your product. To put it bluntly, NVIDIA sells the shovels, Oracle and the cloud giants lease the land, OpenAI digs the quarry, and they are all aggressively hyping the gold rush to lure everyday investors into the mines. But nobody has actually struck a massive, highly profitable vein of gold yet. OpenAI is valued at astronomical heights, yet it is reportedly losing massive amounts of money every single month because running these models is incredibly expensive. AI services are simply not making enough organic revenue from everyday consumers to justify their current stock market valuations. Will they ever bridge this gap and achieve the required profitability? It is possible because they do have some massive levers left to pull. Hundreds of millions of people use these tools every single week, generating an unprecedented mountain of data and attention. Imagine the moment these platforms decide to turn on hyper-targeted advertisement engines, allowing algorithms to recommend commercial products directly inside your intimate conversational queries. Furthermore, these companies are actively expanding into massive, highly lucrative industries, including relaxed restrictions on adult content, and building corporate systems designed to aggressively undercut the human workforce. They are betting everything on the assumption that once global corporations become entirely dependent on AI infrastructure, they will have absolutely no choice but to keep paying whatever price is demanded. That is the moment the AI companies plan to hike prices sky high and finally cash in on their multi-billion-dollar investments. However, that grand corporate plan relies entirely on the third hidden force, the belief that AI progress will continue to accelerate at a breakneck, linear speed forever. We have all seen the rapid evolution, watching AI video generation transform from a terrifying, distorted clip of Will Smith eating spaghetti into hyper-realistic, cinematic masterpieces in a matter of months. The entire stock market is banking on this rapid rate of compounding improvement to continue indefinitely. But the technology is rapidly sprinting toward a hard physical boundary known as the data wall. For years, these large language models have grown smarter simply by devouring every single scrap of public information available on the internet. Experts project that by 2027, AI companies will have completely consumed nearly all high-quality human-generated online content left on Earth. We are running out of fuel to climb the ladder. The massive data sets we have been feeding these machines took humanity centuries of collective culture, science, literature, and history to create. If AI companies cannot find a way to scale beyond this data wall, the rapid rate of technological progress will inevitably slow down, market expectations will violently collapse, and the valuation bubble will pop. While engineers are trying to bypass this limit by creating synthetic data or teaching AI to learn through environmental interaction, rather than just reading text, it remains an unproven gamble. Humans don't learn just by reading trillions of sentences. We learn by living, failing, feeling, and interacting with a physical reality. AI hasn't lived your life, it hasn't had your unique conversations, and it hasn't made your personal investing mistakes. Which means scaling past this wall isn't just a question of accumulating more data. It requires a fundamental scientific shift in how these machines process reality. So where does all of this leave you and your hard-earned money? Is this current situation an exact mirror image of the 1999 dot-com bubble? Not entirely. The crucial difference is that today's tech titans are not empty shell companies. They have massive, multi-billion-dollar cash reserves, healthy cash flows from their legacy businesses, and a clear, functional utility in the real world. But the psychological and structural signs of a classic market bubble are undeniably flashing red. Extreme overvaluation, circular revenue loops, geopolitical mania, and looming technical limits. We cannot predict the exact day the music stops, but you can absolutely bulletproof your personal finances right now. My personal 3-step blueprint for navigating this madness is simple. First, do not stop investing, and do not try to perfectly time the top or bottom of the market. Set up automated monthly contributions that leave your bank account like clockwork and go directly into a broad, low-cost index fund that tracks the total market. When I invested through the dot-com crash, my portfolio took a massive initial hit, but because I kept buying shares every single month through the absolute worst of the recession, I accumulated premium assets at a massive historic discount. When the market inevitably bounced back, as it historically always has, those discounted shares are what ultimately made me millions. The real secret to wealth isn't being a genius. It's having the emotional discipline not to panic sell when the red numbers appear, and ensuring you never over-leverage yourself or invest money you need for immediate living expenses or debt. Second, focus single-mindedly on increasing your primary income. Your personal earning power is the ultimate fuel for your wealth machine. Focus on leveling up your career, negotiating a raise, or starting a high-margin side hustle. If the bourses start to fall, having strong independent cash flow allows you to step into the market and buy up premium assets on a massive clearance sale. Third, aggressively embrace diversification. Putting all your financial eggs into one single trendy basket is a recipe for absolute disaster. Spread your capital intentionally across multiple distinct asset classes. Domestic equities, international stocks, bonds, real estate, precious metals, and even a small calculated allocation in alternative assets. It is also incredibly wise to look into resilient, dividend-paying companies. They act as a beautiful defensive shock absorber during market downturns by paying you consistent, reliable passive income regardless of what the broader stock charts are doing. Market corrections and bubbles bursting are not the apocalypse. They are the single greatest wealth transfer mechanisms in human history. If you understand the structural forces at play and maintain absolute control over your emotions, you won't be the one running for the exits in a blind panic. You will be the one calmly, strategically buying up the opportunity of a lifetime while everyone else is fleeing.